The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Looking forward. Excited for the show.
Really?
Yeah.
Remember, we developed this show to answer your financial questions. So if you have any financial questions, and we pretty much go the entire, anything financial, we've got more credentials than anybody I know, and we can answer pretty much everything. The only things we don't do, mortgages. We know stuff about taxation.
Well,
on mortgages.
if we don't know the answers, we'll certainly know where to find them for you.
And we're not real estate people, so we don't do real estate stuff, even though we own real estate.
And lately, it's been pretty good.
Oh, it's been excellent. Don't hesitate to call us at 972-715-2424. Our philosophy at Dillon Gage has always been and will always be, and it keeps proving. Almost every study we see lately keeps proving what we've been doing here for 20, 30 years, that it makes the most sense if you're about to retire within 10 years of retirement to have a retirement income plan that will pay your expenses, at a very minimum your hard expenses. Once you have that, the stock market is a great place for covering maybe future inflation, but that's once the bills are paid. The stock market was never designed to pay your bills because dividends are not guaranteed. High yield on bonds is not guaranteed. So you need something that's guaranteed to pay the bills, because trust me, those bills coming in every month is a guaranteed thing.
And what this does is it augments or supplements your Social Security. I know we all are a little fearful of means testing and what might happen with Social Security, but just think, if you didn't have Social Security, you had no income whatsoever other than the money you saved and what you could generate with that. That'd be scary, wouldn't it? Right. But we've got a cushion. We've got $3,000, or if there's two people in the household, $4,000, maybe $5,000 a month that's guaranteed from Social Security. I mean, it feels really good to have that safety net. Unfortunately, with inflation and expenses nowadays, that's usually not enough for a household. Usually you need another $4,000, maybe $5,000 a month. So instead of having $3,000 or $5,000 guaranteed, what if you had $10,000 or $11,000, whatever your needs are, that you knew would come in? It was an absolute. I mean, it just really makes retirement so much more enjoyable.
Most people, when they're planning for retirement, they do simple math in their head.
Right.
It's 99% of people do it. In other words, they'll say, all right, I need $5,000 a month. That's $60,000 a year. I've got $1.2 million.
I'm going to make 7% a year.
20 years, that'll last. Even if it doesn't make anything.
Right.
Okay, I'm fine. I know it'll make something 20 years. The one thing they forgot to factor is inflation. I'll give you a quick story. I opened a bill this week. I showed it to you, Guy. I opened a bill, $573 for 1 month. That is my water bill.
I heard him screaming 2 doors down the hallway when he opened his bill.
$600 for water. Think about it. Who would have ever thought our water bill could rival our electric bill, right? It's shocking to me. Now, they give you a nice little chart on this water bill. Shows, look, you use the most in the summer. That's probably water in your lawn.
And there's usually some waste management charges.
But this year wasn't as hot as last year, so I used less. But last year, I never had a $300 bill. How come this year, using less water, I've got a $600 bill?
Inflation, maybe?
They keep raising the rates.
Yep.
And they're not going to stop. Okay? Water bill right now is getting ridiculous. So I need to find somebody who's buying this water, because they're rich. Because they're ripping people off on the water.
Well, and to digress a little bit, but to extend the story, whoever thought you'd pay for water in a bottle to drink?
Oh, no.
20 years ago, never happened.
No, water in a bottle, even though it's not that expensive, is 30 times more expensive than gasoline.
Yeah.
Who'd have thought?
Yeah, if you'd gallonize it, yeah.
So that's why you have to factor in inflation. There are certain things that are not going to go down. If anybody in their right mind thinks real estate taxes are somehow going down, they're going to lower your valuation and lower your taxes.
As soon as the tax basis gets large enough, we're going to lower your
That's right.
homeowners
They're going to lower that just like that. They raised our water during the drought a year or two ago. Well, it looks like the lakes are full now, and they sure haven't lowered it. I think they've raised it even further. Well, just to protect us from the next drought.
We're building a surplus.
That's right. Just like the electric companies. Remember, they go to the state and want to get increased rates?
Right.
And they did it for natural gas prices because they were tied to natural gas prices. Well, natural gas prices have been nothing for years. Well, the other factors. And they never lowered it back when natural gas went down. They never lowered it back. You have to account for those kind of things in every financial plan and retirement plan. Those things obviously have gone up more than the typical inflation rate,
Right.
but other things haven't. And that's why we do these reports. We do a comprehensive view of your finances to see what the potential holes might be. And then we'll give you suggestions if there are holes. If there are none, that we'll be the first ones to tell you. If there are holes, then we'll make some suggestions to plug those holes.
And I always try to add in at this point, if that's a little too complicated or too much and you end up procrastinating, we all do it, so we empathize with you. We also can give you a quote, how much income you could make if you've got 5 years until retirement, or 10 years and you've got 200,000 or 400,000. And with your ages, real quick, real easy, we can give you an actual quote for your situation, which will shine a lot of light on what you'll need in your retirement.
You'd be surprised. Like I said, somebody told me just 2 weeks ago that I'm going to sell this business for $3 million.
Right.
And I can probably get, 5% at the bank, so $150,000 a year and not touch your principal. I'm like, whoa, when's the last time you looked at the bank?
What bank are you using?
Whoa. They go, well, can I get 5%? I said, you can get 5% somewhere, but you're going to be eating your principal. And they go, well, I don't want to do that. I go, well, it's 1%. They go, well, who can live on $30,000 a year?
Well, no, there's some high yield bonds.
Yeah. Right now, 10-year bonds are paying, investment grade are paying like 2%. If you ever looked at an investment grade chart, it goes from like AAA down to BBB, right?
Right.
You go just one step down, it's about a 0.1 default rate on the BBB stuff. Pretty low. I mean, in other words, 99.9% don't default.
Negligible.
Great, right? One step down is like 15% default rate. Then it starts going up. All of these people buying these high yield bond funds don't realize what they have.
And the rates go up each notch too, right?
That's right. So you've got huge default rates. We just haven't experienced it yet because interest rates have fallen for 30 years. But now that they've fallen to zero, can't fall below there really.
They can't refinance if they need to.
That's right. They can't refinance out of the debt. So you're going to see defaults actually go up exponentially if you start getting a rising interest rate environment. Now, I'm not discounting the fact that the Fed is very prone to keeping interest rates where they are and not really raising them. If they do, a quarter here, quarter there. But sometimes they drift up on their own. So we're not trying to scare you with hyperinflation, but I am telling you there is a real risk to anything bond related in your portfolio right now.
And if you prepare for the worst but expect the best, you'll have the best of both worlds.
Right. And like I said, if you'd like to take advantage of our comprehensive retirement plan where there's no cost or no obligation ever, or you just like a quote, I have this amount of money, I'm going to retire this time. How much income can I get? We'd be more than happy to do that. 972-715-2424. Again, 972-715-2424. I live out in Prosper and have a lot of friends of mine out there that, some of them are pretty well off and they have amassed a little bit of money. If you can have the foresight to take a little bit now to guarantee an income stream, even if it's 20 years from now because you're younger, right? You can do it for pennies on the dollar to recreate the same pension, the personal pension you're trying to get for yourself. So it's never too early. It's never too late. Because right now we're trying to make your position better.
We ran a scenario for somebody in their mid-30s, very young age. But if you can put $2,000-$3,000 a month, seems like a lot, certainly in your mid-30s, away, the amount of tax-free money that you can generate when you're in your 60s is a crazy big number. So there's lots of different alternatives. We always pride ourselves on being solution-based. So we try to figure out what works for you, what you need, what your age is, where you're going, and then back into the best possible solutions and then present you with the options.
Right. The laws, and what's also included in these plans, obviously, is the Social Security laws have changed here a few months ago. Well, we have that update in our programs and can show you all the different ways to get Social Security. What happens is everybody does simple math when they do Social Security, just like they do on retirement planning.
Right.
They're saying, okay, if I take it at 62, it's this number. It's a lot bigger number here at 66 or 67.
Do
but,
I want to wait or not?
Yeah, I'd have to be 78 or 80. Well, nobody in my family lives past 70. So I'm going to take it early, bird in hand. The truth is, the one thing you forgot is cost of living adjustments, and also you forgot.
We're living longer.
If you live to 85 or so, how much did that actually cost you? This program will show you. If you take it early, here's what you get. If you take it on time, here's what you get. 70, then it'll give you strategies that can make it where, all right, one person takes it at 68, one takes it at 63, and that's actually your maximum return over this life expectancy. It does all that automatically. And we can show you how that, and like I said, because Social Security is such a big piece of most people's retirement nowadays, you want to maximize the benefit. It was your money, even though the government says it wasn't.
That's certainly the foundation of your retirement.
It was your money. You get the most out of it. Our number 972-715-2424, or go to ilovemyretirement.com. All right, we got a break coming up. After the break, we're going to answer your questions. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. All right, we're going to go over your questions today. These are questions that come in from emails, personal consultations, from phone calls, interviews. Anytime that we find a question that we think is going to appeal to a broad audience, we're going to share it with you. We never use names. I know a lot of people do that for marketing purposes to show you them they're real. But I can assure you these are real questions. And I think that, like I said, by answering questions this way, we really think you can use this advice right now in your financial lives. We obviously do this show for people to bring us business. But no matter what, you listen to this show every week, I promise you one thing. The only thing I can ever promise about this show, you'll learn something new almost every week. All right, what's your first question, Guy?
All right. I don't know about them, but I learn new stuff every week. How about you? All right, first question. Uh-oh. I hate a question that starts out, I'll be honest. Here we go.
I had some bad things said to me.
Lying to me the rest of the time? All right. I'll be honest. I've never thought it was worth paying someone to manage my money. My accounts are with Vanguard, and I've done fine. How would you convince someone like me to hire an advisor?
Well, first, I would never try to convince anyone to hire an advisor. It's either self-evident or it isn't. In your case, if you're okay with the risk you're taking, and you've done well, I think explained that you've done well, there's nothing wrong with managing your money. I mean, absolutely nothing wrong. The only potential problems come into play is, let's say, in this case, it was a husband. I think he said but a husband and the wife knows nothing about finances. But let's say she's just as adept to finances as you are. Well, then I still don't see any problem. But maybe they're not. So what happens if you pass away? Who is that person going to go to? And I worry when you do something that quickly and rashly, especially emotionally after someone passes away, you might not pick the right advisor. You might not have the right vetting process to pick one that's not going to, for lack of a better word, screw you over.
And you touched on a good word there. You're talking about emotion based on someone passing away, but we've talked about it many times on the show. One of the single most important things an advisor can do for you, and again, the assumptions are you vet your advisor, you've got one with the licenses, with the experience and the knowledge, but you eliminate the emotion. When it's your money, it's your life savings, it's difficult at times to make the right decision at best. And a lot of times when the market's up, you're getting in and out at the wrong time. When the market's down, you're getting out when you probably should stay. May have to do with emotion, may have to do with not having the proper balance. And Vanguard, in my opinion, is a very good company. We recommend that a lot for clients of ours, friends and kids that need help, that have smaller amounts of money. But as you get older and as you get into the distribution phase, when these averages and these numbers change and you're starting to withdraw from these accounts that have low fees and they're giving you all the dividends, but we have a bad year, and make no mistake, we'll have a bad year. It's okay to have a bad year if you're spread out and you're balanced. And again, I have to interject our philosophy. If you take care of your hard expenses, it allows you to do that. So maybe you take care of your hard expenses with some experts that are really good at developing income for you in retirement, and it allows your Vanguard accounts to even do better.
Let me say, I went to the doctor this week. Okay, This relates.
You're
I
getting older.
I know. I used to make fun of people taking pills. Now I'm like, which one is this pill? Well, I was at the doctor, and they said, well, which one I think it is. And I'm like, well, I read on WebMD that this right here, and this in the Mayo Clinic, by the way, I went on that website too.
Yeah.
And it said this, and they said, oh, okay. So you know more than me now, huh? I'm like, no, I'm just saying, what have you checked into this? Well, yeah. I've seen this situation thousands of times in the past. And that's what I try to tell people you can be really good at managing your money. Okay. But you've been managing all this time in that growth phase, like you're talking about, instead of the distribution phase. But I can tell you a seasoned advisor has seen 1,000, 10,000 different scenarios.
Absolutely.
And you don't know what you don't know. And that is the problem. You can't properly prepare for what could happen in retirement when you're only using a point of view that is your own.
And that's a problem with book knowledge. Book knowledge is great, but think about it, no matter what field you're in or what field you've retired from, when you had interns come in or sharp kids that graduated from college, all their whole knowledge base is from the past, right? It's good knowledge. You're a nuclear chemist, Victor, in a former life.
Yep.
So, you're armed with all that stuff, but you don't know the new stuff. You don't know what the market's going to show, what new discoveries are. And that's what seasoned professionals see and do all the time. It's completely different than book knowledge. And if you're managing your own account, that's kind of what you're limited to, and you're very limited to the amount of situations you've seen.
No, it'd be like right now you can go get a book, at a medical school that teach you how to operate on yourself. Now, there's some pain and stuff like going on, but you can probably teach yourself how to anesthetize yourself and all that. Maybe not the best idea, but maybe it's a simple procedure. Either way, I'm not trying to say surgery on yourself is the same as doing your own finance, because it's not. But I am saying emotionally and all that kind of stuff, if you can have that kind of advice and that kind of experience behind a decision, at least for a portion. Like I've got people that, they give me their safe money or whatever, or their money they're going to create income with. Sure. They manage the rest. And so they've got the control that they want.
Right.
But at the same time, something happens to them, their spouse is taken care of from a trusted advisor. So there's all kinds of different reasons. But I would never, the answer to the question initially, I would never try to convince anybody to have an advisor when they're doing it fine on their own. I would just point out the different types of potential outcomes that could happen if they don't.
And in those cases, a lot of times what we do is, again, solution-based. We can point out a lot of different options. If you like some options, if through the financial plan it shows you that it may do better, we're happy to implement some of those for you on a portion of your money.
Right. And also, it's hard to analyze yourself. To self-diagnosis is very difficult in retirement planning or financial planning.
Emotion.
Having a second opinion, even if you don't go with them because you might think they're idiots after the plan, but it's having another opinion for pretty much anything that's important is not always a bad thing. Oh, we got a break coming up. Remember, if you have any financial questions, call us at 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions or you'd like to take advantage of our retirement analyzer, retirement income plan, remember all of those services come at no charge. We also do your car insurance, homeowners insurance, business type insurances. Anything that you can do, don't hesitate to call us, or you'd just like a quote. I don't want to go through all that. That's a little more detailed than I'm ready for right now. I've got this amount. I'm this age. I'm going to retire this. My wife's age. What can I get?
How much money can I get?
That's right. No problem. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com.
Hey, before we went to break, Victor, and to the listeners, we were talking about the pros and the cons, hurdles of managing your own money and the emotion and that sort of thing. Victor, you went into an analogy of if you did surgery, minor surgery on yourself. And, I wanted to add to that just a little bit. It's the unexpected things. So, whether it's a small removing a cyst or something with a local, what if you hit a capillary or something? If you're not in that business all day, every day, the book for removing a cyst may not have mentioned capillaries, right? So all of a sudden you start bleeding. Anyway, you get into a situation where you really don't know what to do, and it's your own body, it's your own arm, to continue with your analogy, and then it kind of freaks you out a little bit, and mistakes are made. Same thing with your finances and your retirement. you'll run into things that you just don't have experience, and book knowledge may not provide the answers for you.
Right. A lot. And, I have a lot of engineer clients, and for me, everything is logic-based.
And they've got everything scripted
It's
out.
got to be
if
math
anyone does.
and logic.
Yep.
I don't like emotion. Somebody gives me some sales pitch, I cringe, I recoil.
Your mind shuts down.
I don't want to hear everything they're saying from this point on. Even if I'm not being rude, I'm not going to leave, I've checked out.
Yep.
And so we don't do that at Dillon Gage. It's all math. Here's what you have. Here's the potential outcomes. Here's an outcome you might want to avoid. And here's a couple strategies that might help you with that.
We've had potential clients come in, both of us, almost weekly, and they'll be ready to do something. They've heard the radio show, so you've got some credibility. You kind of go through some alternatives. Okay, we're ready. Both Victor and I will send them home with the information, tell them to sleep on it, talk to who they need to talk to, and then we have a second or even a third meeting, because you absolutely have to measure twice and cut once. This is very important
I haven't
stuff.
had a complaint in 30 years. I'm not starting now.
That's right. That's
Right.
for both of us.
All right.
All right, you
What's
ready?
the next question?
It looks like a long one here. All right. I have a managed account at one of the big firms. I guess that'd be a wirehouse.
Yeah.
I was told that I was going to pay 1% per year in fees. A friend of mine adamantly told me that I'm paying more, even though I told him I watched the fees and have never paid more than 1%. Can you help settle this argument?
Okay. It depends on basically they're saying he only gets charged 1%, so he can't be paying more than 1%. Well, that's not true. Okay.
That's the 1% that he can see.
That's 1% you can see.
That's right.
What happens is they'll put you in mutual funds typically. About 80-90% of managed accounts are in mutual funds. These mutual funds will disclose some of the fees. They won't disclose all the fees. They'll disclose that they're there, but they can't put a number to it. Like they'll disclose management fees, 12B1 or marketing fees.
Right.
But they won't disclose like the turnover cost. In other words, how much they pay per trade. And trust me, you think they're paying pennies because it's bigger money. They're actually paying more because they split the profits.
Well, in stocks, you have an actual price per share, and you know exactly what you're paying, and everything is outside of that,
Right.
whether it's management fees or commissions for the trade. With mutual funds, you have a NAV. It's an acronym, NAV. It stands for net asset value, which is how they come up with the unit cost.
Right.
And all of that stuff is disguised within your NAV.
Right. Now, if you have a managed account with individual securities, individual stocks, no, ETFs, no funds, no bonds, and they're not charging any fees beyond, then you might be paying a pure 1%.
Correct. That's right.
So the cheapest way most people do, because individual securities, I mean, you'll see some advisors argue with this, but I have no idea what leg they have to stand on. Doing individual security management, because you can't diversify enough.
Right.
Think about it. You buy the Vanguard 500. That's 500 stocks representing 80% of the U.S. stock market in every single sector.
And 0.2% a year in fees, give or
Right.
take.
And so how can you buy enough individual stocks? You could buy all 500 of them, right? But you're better off just buy the dang thing at a 0.08% or what is not worth buying 500 securities when you could buy one, right?
I'd like 5 shares in these 500 companies, please.
Right.
What?
I'm just saying it's very difficult to do. And so most people do managed accounts. So I see managed accounts all the time that charge 1 to 1.5%. They're putting them in mutual funds, charging between 0.5% and 2%. So you could be paying 3 or 4% a year and think you're paying 1. So I don't know what this question said, settle this with my friend. If you're individual securities, I just settled it. You're probably paying 1%. If you're in anything but individual securities, it's impossible to pay just 1% if that's what you're seeing come out. And we can actually look at that for you if you'd like.
Absolutely.
And show you, okay, what kind of fees am I actually paying? Because I don't mind paying a fee if it's reasonable, but I'm not paying 3 or 4% to anybody.
Probably can help you reduce some stuff.
That's right. Our number 972-715-2424, or go to alliedmyretirement.com. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Let's get right back in it. What's your next question, Guy?
All right. This is a good question. What kind of effect will the elections have on my finances? And I would tell you,
Uh-oh.
it depends how you vote.
Don't get him started, folks. He will go.
No, don't start me. Don't wind me up.
I'm going to be very careful not to get you going here.
Okay.
Well, no matter which side of the political spectrum that you set,
Oh, that was PC. That was politically correct.
we're just going to analyze how it could potentially harm our listeners. How about
Absolutely.
that? Now, albeit our listeners are and our customers are, middle class to upper middle class typically. And so how would it affect these people is what we're going to discuss. I'm not going to go into anything about,
Policies.
anything. Yeah,
or- yeah.
we're just going to talk about, all right. And so what affects a middle to upper middle class person more than almost anything out there? Taxes affect them. If I could figure out a way, if you're an accountant out there to somehow get my taxes down, you call me.
They just want you to release
Ridiculous.
them. Are you going to release your tax returns?
Oh, you can release mine all the time. Somebody goes, well, do you mind scared of getting audited? I go, no, I pay 40% taxes. I don't care if I get audited. What else can you do? Like, oh, we didn't like this one gasoline you filled up, and we don't think that was all business.
That's right.
They can't get much out of me. I already pay everything. That's what I remember.
But I tell you, it's a good question. It's very scary.
Yeah.
I tell you, I feel people when I talk to them on the phone and in person right now, they kind of are feeling paralyzed. They don't know what to
yeah.
do. And when people don't know what to do, what do? Nothing.
That's right. Analysis paralysis. All right. Well, Clinton would like to impose a 4% fair share surcharge. Every time I hear fair share, it just makes me madder than people that are telling me to pay my fair share. I mean, I'm paying 40%, right? Don't pay anything typically.
And they're mad at you because
That's right.
Yeah, you make too much.
I'm already paying 40. We pay 90% already. That's not my fair share. Oh yeah. Okay, but forget that. Sorry. If you make more than $5 million annually, if you the Buffett rule has a minimum 30% tax if you make $1 million annually. Okay.
So that would be the new AMT, alternative minimum tax, $1 million plus.
Yeah.
30.
See, AMT is different than 30. 30's worse probably. Trump would reduce the current 7 tax brackets to 3, make it 12, 25, and 33. Okay. Capital gains and investment taxes. Clinton has proposed higher capital gains rates on short-term investments. Hasn't changed the long-term investment rate, which is lower, but short-term one's higher. But it's already your full tax bracket. How can you get it?
Yeah, I don't know what you could do there.
I guess even more. But Trump didn't mention anything about investment taxes. All right, taxes on retirement plans. Oh, you never thought you'd hear this one, did you?
You know, as I hear you saying this, not to interrupt you, but you know what's going through my head is people who promise to raise taxes usually follow through.
Yeah.
People who promise, politicians that is, promise to lower taxes don't always follow through. So what's wrong with that?
All right, Clinton would end what she calls the Romney loophole through limiting the ability of very wealthiest to game the system by sheltering large incomes in tax-preferred accounts. A summary of their campaign website states, she also mentions building on President Barack Obama's proposals in this area.
Does she have a how-to book there on how to set up a foundation? Oh, I digress.
Trump doesn't specifically mention anything about taxing retirement plans. Taxing retirement plans scares the crap out of me.
Yeah.
Okay, because that is a benefit that we don't get many benefits anymore. You know, used to they had higher tax brackets in the 70s, like when my dad was paying 80, 90% tax, but you could write everything off. Now, effectively, we have a lower tax bracket. We're effectively paying more taxes because you can't write anything off anymore.
That's right.
All right. I hope, folks, you can see which way I'm leaning on this so far. Estate tax. All right. Clinton wants to go back to the 2009 levels. This is before they made it permanent, the $5.5 million per person or 10
Lifetime
million.
exemption. That's right.
What that means is anything over these numbers, you got to pay,
Estate tax.
40, 45% tax, estate tax. It's called a death tax. In other words, you pay tax all your life. Before you can pass it on to your kids, they got to pay another tax.
Tax it again.
So we're taxing. Because remember, you already paid tax on this, and you're trying to give it to your kids. They got to pay tax again on it.
And just think about it. If they save it and they're good custodians of the money, they don't spend it. When they die, pay tax on it again.
That's right. And Trump would eliminate the estate tax. Okay. Carried interest. Carried interest is very few people ever use carried interest. That's usually hedge fund guys and all that. Clinton would eliminate it, but so would Donald Trump. They don't like the carried interest deal because you got hedge fund managers making billions and paying no taxes or something like that. That doesn't sound right. Child care. Clinton wants to expand the child care tax credit. Trump wants to provide an above-the-line deduction for child care expenses. Low-income taxpayers could deduct them right from their payroll. So that's actually a direct deduction, which is actually pretty good for lower-income people.
And if you're young enough, as we talked about probably a couple segments ago, there's some good plans where if you start putting money away monthly now where you can get some tax-free income that won't be affected. If you get your income taken care of, like we talk about, there's some good things that'll make it easier for you. And I just wanted to throw out our number, 972-715-2424. That's 972-715-2424. Call us and we can talk about this more personally based on your situation.
I mean, I'm fiscally very conservative. Somebody goes, well, what if I... Trust me, you want a financial advisor that's fiscally conservative.
That's true.
You do not want a fiscally liberal financial advisor, period. But child care is one thing. I know people pay $1,000 to $1,500 a month per kid. You got a couple kids, it prevents people from getting jobs because you can't make enough after taxes to pay for their child care.
That's right.
So I get that. Corporate taxes. She didn't really mention corporate taxes in her plan. Hasn't mentioned them yet anyway. Trump would establish a top corporate tax rate of 15%, which applied to businesses operated on the proprietor's personal income tax return as a pass-through. I would love this one because, we're a small corporation. Oh, this would be fantastic for me. But all we're doing is talking about taxes. Whoever gets elected, what is better tax-wise? Obviously, reducing taxes is better and all that stuff, but I get the social, things on the other side. But that's all we're talking about for this show because it's a financial show. All right, stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember our philosophy here at Dillon Gage. We believe that every person should have their expenses guaranteed in retirement. The one thing that always shocked me is I always think about insurance because I hate paying insurance premiums. Just saying. You finally make a claim, they drop you. I just can't stand it.
Or raise your rates. Yeah, you and everybody else.
But think about it. You have insurance on your home, even though you could replace the home, right? You have insurance on your car because you don't want to get sued and don't want to, you want to pay for the damage.
And if you lost your car, quite frankly, it's not going to ruin your retirement.
That's right. But what kind of insurance you have on your lifestyle or your retirement? In other words, something you might have to live on for 30 or 40 years. Why would you insure at least your bills being paid? But that's the kind of conceptually what we're talking about. Ensure that the bills are paid first, and then the stock market is a great place. There are all kinds of other investments you can do to cover inflation and things like that, but at least your bills are paid.
No, I'm going to take it a step further. Your bills are paid plus a little more.
Right. Well, see, to me, that's the ideal retirement. At a minimum, I want the bills paid.
There you go.
But let's say I've got $10,000 a month in bills. I would prefer 12 or 13 coming in just to give me a little bit of cushion because you never know. My wife might want a new pair of shoes or something like that.
Now, what if you had something that could do that for you and increase that payment
till you die,
along with inflation until you die?
Guarantees for the rest of your life. You can't run out. Your bills are paid and increases the payment. Well, they have those. And remember, if you'd like a quote or a full retirement plan, there's no obligation, no cost to anything that we ever offer on this show. It's 972-715-2424. Let's say you've got $750,000 you're going to retire next year, or $14 million, whatever the number is. And you want to say, what kind of income could I get? We're going to show you. Now, the income is different than it used to be. It's not where somebody's going to keep any of your money. No one keeps any of your money if you pass away. Your money still grows, and you have access to it and can change your mind at any time. That's important.
And depending on your needs, if you had, let's say, $750 was in your retirement accounts, and depending on what your needs are, certainly a lot of variables, what your Social Security is. But in the cases we see, maybe you only need $250 of that to generate the income you need to bridge the gap.
That's right.
And you've got $500 that you can diversify in the market and different things. Maybe you need $500 to generate the income, but the $250 is now free, and it can grow back to $500 or $750 because you're not drawing on it, needing it. There's a lot of neat things that happen once your income is taken care of.
Our number 972-715-2424. Again, 972-715-2424. 2424 or go to ilovemyretirement.com. All right, what's our next question?
All right, short and sweet. This one comes up a lot, so a lot of people must be thinking about it. I'm considering rolling my 401k into a Roth 401k. Should I pay the taxes from cash or take it out of the 401k?
No, the short answer is always pay it in cash.
That's right.
Let's say you've got a $100,000 regular 401k, you're rolling to a Roth 401k. Well, remember that's $100,000 going to be added to your income that year. So even though you might not normally be in the 35% tax bracket, you might now.
Yeah.
Okay.
Chances are you will.
So if that's the case, you're going to owe $35,000 in taxes on this particular transaction. If you take it out of your 401k, you're going to have to take out like the 35 plus enough to pay the taxes on it, right? Because you got to pay tax on everything you withdraw. So in that case, I haven't done the numbers, but you're going to take out probably $50,000.
And if you want us to help you and take a look at that, we're more than happy to. Again, this is specific to your needs, but if you have $100,000 and you want to roll it over to a Roth and it makes sense, which we can help you go through the numbers, maybe you don't lump sum it, meaning maybe you take $20,000 a year for 5 years and convert it so that it keeps you into a lower tax bracket so you don't lose as much in taxes. There's many different ways to do it, and it's just we do it every day. We're very easy to do.
Think about the
stuff.
example we used. It took you all your life to save this $100,000 in an IRA, and now it's $50,000. Yeah, it is tax free now.
That's right.
All right, but it's $50,000 instead of paying the $35,000 in cash and still having $100,000 tax free.
That's correct.
It allows you to actually put money towards that bucket without the limitations you normally have on that bucket.
It's kind of a loophole, really.
That's right. So definitely pay it cash if you have it. And remember, you have to determine first whether it's worth it. That is a big thing people don't understand is for most people, it's not worth converting to a Roth. I understand you're protecting yourself against future tax increases, but typically you have an income stream from the job when you're working and not when you're retiring. So typically, almost always, I don't care what if taxes go up, you will be paying less, a lower tax bracket in retirement because your paycheck stopped. So those should not be converted to a Roth. But if you have any of those kind of questions, again, don't hesitate to call us, 972-715-2424. I think we got a minute left, Guy. Give us one more question.
What is the biggest mistake people make when it comes to saving for retirement?
It's a complicated question. We can go on longer and another thing, but the biggest thing, honestly, is they keep, every time they get a raise at work, or they keep raising their lifestyle immediately instead of being a little more prudent. In other words, people don't buy the price of a house, they buy the payment. And so they're like, okay, the mortgage company said I can pay 35%. That's $3,500. We can afford $500,000 house. Instead of buying a $250,000 house and saving the difference, everybody does the same thing, and they'll buy the maximum. The average part of your home expenses is 35 to 38%, which if you can lower that and resist the temptation to keep going up to the max, keep it like half of the max, you're going to be much better off.
Short answer, live within your means.
That's right. Well, that's our show, folks. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any financial questions, would like to take advantage of any of our programs, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.